Hello there, everyone, and welcome to this special all-mailbag edition of The Final Bar. It's Friday, July 26, 2024. Hope you guys all had a great week, survived all the volatility, all the uncertainty. We'll get back to it again next week. But in the meantime, let's answer some of the great questions we've received recently in the Final Bar mailbag. As a reminder, the mailbag is always open. We're always interested to hear what questions you're running into as you are analyzing these markets using the Technical Analysis Toolkit and the Stockcharts platform. Our email is thefinalbar@stockcharts.com. On Twitter, just tag us in a comment at FinalBarSCTV. And here on the YouTube channel, just drop a comment below the video that you're watching. We hope to hear your question, hope to answer one of your questions in our next mailbag episode. Let's get right to question number one. Dave, how can I differentiate a distribution day from a correction using technical analysis? Really interesting question there. And to be honest with you, I would say that the answer to your question is it depends, right? Because those are actually terms that are kind of used in some ways with some expectation of consistency, but in a lot of ways, words, phrases like a distribution day or a correction or a corrective move, a pullback, these are all kind of used interchangeably to refer to something that probably had been going up and is now not going up, and in some ways is probably going down. So what do these different things really actually refer to? When we talk about a distribution day, we're usually talking about like a one-day downward move that could be part of a larger trend. And the idea of a distribution day is that it's on heavier volume, meaning the implication is that investors are selling off shares, and so that would cause the price to go lower and would certainly most likely cause the volume to increase. I'm adding some things on here. So like here, we're adding volume. I'm going to say color volume. So a great way to look at distribution days, by the way, is below on Stockcharts on our platform. Below there, make sure you have volume turned on. And I use overlay, but you can make it as a separate indicator. Overlay kind of puts it right by the price action. And then I would select this one that says color volume. What that's going to do is up days in price, the volume is going to be in a black color, or some. It might be a little different on your computer, but that's pretty consistent, I think. And then down days are going to be in red. And so the idea is up volume is in black and down volume is in red. So after we had this peak, second week in July, we have this one big down day, right? So we have an up day and then a down day. That's actually a bearish engulfing pattern as the QQQ went above $500 a share. But look at how the volume is way above average and it's in red. Then you have all these subsequent days over the last week or two. Big down days in closing a lot of ways, and we can see that by the fact that the volume is colored red, which means it was a down close, and we can see it's higher than normal. So those would constitute distribution days, which would be a big down close on heavier volume. Now, distribution days, as they sort of continue, then I think the larger trend becomes something you could probably call a pullback and or a correction. Now, a lot of people abide by sort of the generally accepted level that a correction would be any move over 20%, and until something moves 20% off of a high, it's not really a correction, it's something else. And then if it, but I'm less of a hard and fast, that it's not like the difference between 19% down and 21% down is this dramatic difference. I think anywhere down in that range is a correction, to be honest with you. So I tend to use those terms a little more loosely. You will hear people referring to a particular 20% move as being officially labeled a correction. Overall, I would say a pullback. Generally speaking, pullback would be a briefer drop of like 5 to 10%. A correction is something closer to like the 20% range. But those are really, I don't think, hard and fast rules. Those are more general ways of describing a market that had been going up and is now going down. And the question is how much more. So again, distribution days are important to watch. It's interesting to note over the last couple of weeks how many distribution days we've seen on something like the NASDAQ, with growth stocks obviously struggling. Next question. Do you make use of market profiles? And if so, how? That's a really good question. And the answer is, at times in my career, I definitely have. Earlier in my career, in my Bloomberg days, I spent a lot of time in Chicago, a lot of times on the floors of the exchanges, many of which, if not all, are kind of shuttered at this point, but the CBOE, the CBOE, the CME, and used to very much enjoy just the noise and the energy in the pits, and just seeing how traders on those short-term timeframes would be using technical analysis. And two commonly used techniques there are point and figure charts and market profile. Market profile is a discipline really created by Pete Stoudemire, who decades ago wrote a book. Forgive me, Peter Stoudemire, for not remembering the title of the book, but I think it's probably the only book he wrote on market profile. Robin Mesh is someone I do know. She's actually based in Portland, Oregon. She wrote a chapter in the book I edited, many years ago for Bloomberg Press, now Wiley. And she talked about applying point and market profile, that is thinking about running it on spreads and thinking about the relationship between pairs of stocks and how they might be illustrated with market profile. The concept of market profile is looking at distribution. So it's a measurement that comes off of the left axis and kind of builds out, and it's based on where the price, how much time we spend in different price levels. And I've worked with traders in Chicago that all they use is market profile charts. That's it. I mean, they don't use anything else. One way to kind of get a kind of market profile type of thing would be an indicator we have on Stockcharts called volume by price. We don't really feature the market profile system on our platform, but volume by price is basically a way of looking at trading volume at different price levels. And here's that distribution that I was telling you about. And you can customize this to make it more or less granular and look at different time frames to see what the profile does. But the general idea is that a market will find an equilibrium, and once it sort of has an initial move, you will sort of fill out a bell curve, a normal-shaped bell curve around a particular distribution. And once that bell curve is completed, you're probably ready to move into another area of focus, another price range where you will create a new bell curve. Volume by price is a similar way of looking at trading volume at different price levels, just to really focus in on key levels where there's been a lot of liquidity, because you can often expect additional support or resistance in those ranges, and recognize when the market has made a very normal distribution versus something that's more abnormal. This would be something like a B-shaped, a lowercase b, and a capital P would be the other one, where there's a bunch at the upper end and a gap in the lower end. The argument is we probably need to fill out that distribution until we can move elsewhere. I would encourage you to look up the work by Pete Stoudemire and one of her students, Robin Mesh, who has done a great job really promoting market profile over time. Thanks for that question, by the way. Next question. Do candle patterns on a weekly chart have the same meaning and relevance as they do on a daily chart? And thank you so much, by the way, for sending a chart with you. You sent your chart of the S&P 500 Equal Weight Index, which is $SPXEW on the Stockcharts platform. I sort of adapted your chart just to clean it up to make it easier to answer your question, but I appreciate you sending the chart along with you, by the way. And your question is, what about candle patterns on weekly charts? Do they still matter? My answer would be yes. And I would tell you, people look at a lot of different things. And I will tell you the way that I have, having studied candle charts for many years, I would tell you this. I think one of the real benefits of candle charts is the fact that they represent data very visually. Bar charts, which I use more than candle charts, to be honest with you these days, are great at just representing trend and just having a basic sense of volatility and then analyzing the trends over time. But if you really want to think about the short-term dynamics, if I'm more of a swing trader, I would absolutely 100% prefer candle charts because they visually demonstrate price dynamics on the short-term time frame, I think, in a very beautiful and simplistic but powerful way. So I think the point of this, if you know candle charts, is every candle represents one period of time. In this case, we're looking at a week. So the open is Monday's open, the close is Friday's close, and then the stem of the candle gives you the intra-week, right, during the week. What's the highest high and lowest low that we experienced during that week? I think it makes sense on daily charts and weekly charts because there is a defined start and finish to that period of time. On a daily chart, you have the open at 9:30 Eastern, you have the close at 4 p.m. Eastern, and then there's a break. And so it makes sense to think about the open to the close versus the range and draw some conclusions. I would argue the week gives you the same thing. So last week, when the S&P equal weighted gave what's called a shooting star candle, I think that means something because what it tells you is at the beginning of that week, that 1 week period, we traded around a bunch of places, but by the close of the week, at the end of the week, we were right back at the lows for that week. So I think that makes sense. What I don't think makes as much sense would be drawing that kind of conclusion from a monthly candle chart or a quarterly candle chart, because April 30th to May 1st is not that might just be a Tuesday to a Wednesday. It might not really be a meaningful break in the action, at which point I think humans are resetting and it's sort of a logical break from one point to the next. I think as indicative senses of how things have moved over the course of the month, I don't have a problem with that. But drawing particular candle patterns from monthly data or quarterly data, not as much of a fan. I have the same issue with hourly candles or 5-minute candles, because a 5-minute period really isn't a meaningful chunk of time. It's just a snapshot, and then the 5 minutes end and a new one starts. A day and a week are a defined period of time with a start and a finish, and for me, that tells me that the candle pattern should be quite valuable. So yeah, I think the shooting star candle in the previous week, pretty meaningful, just like I think big accumulation. It's not quite a bullish engulfing pattern. It's really, really close. I think, makes a ton of sense. Happening right at the 200-day moving average, I would certainly pay attention to that and think that there's some value in recognizing those patterns. Great question, by the way, and thanks for getting me to think a little bit. Next question, what is the relevance of the Heiken-Ashi close to the actual close? Ooh, we're getting into some Japanese technical analysis tools. The Heiken-Ashi candle, by the way, before I bring up the article that explains this, here is Apple, a 6-month chart using regular candle chart. So this is the candle charting that you're probably familiar with. As I mentioned in the previous question, every candle represents one trading day. In this case, looking at a daily chart. So you have the open of the candle, the close of the candle. That creates the body, or the real body as it's called. And then you have the stem or the wick of the candle, which gives you the high, the low, the range, same as you would see on a bar chart. So the shape of the candle and how the candle patterns evolve is very meaningful. Here's a Heiken-Ashi candle, and you can see that it looks very similar, but it's smoother, right? So here's the regular candle chart. Here's the Heiken-Ashi candle chart. And you can see that it somehow has smoothed out the data, right? Instead of these big jumps and gaps and stuff, you kind of have this much smoother series. And it makes it much clearer when we've been in a consistent uptrend versus a consistent downtrend. That is, I would argue, the real benefit of Heiken-Ashi candle charting, is that it really focuses more on the trend as opposed to individual days and their candle patterns, which is how I think of regular candle charts. If you go to Chart School on Stockcharts.com and just hit the magnifying glass or search for Heiken-Ashi, and this is how you explain it. There's this fantastic article where we explain what it is, and the specific answer to your question is this first point on how we calculate it. In Heiken-Ashi world, the close is actually an average of the open, high, low, and close for that particular day. So the close does not mean the 4 p.m. close as it does in the traditional candle charting. The Heiken-Ashi close is an average of those four, and the rest of the points are averages, which is done on purpose to create a much smoother data series. And I would say the benefit is like on a chart of Apple, recognizing the strength from late June really through mid-July, and then just seeing that abrupt change. When there's a change from hollow candles to solid candles, or up days to down days, on the Heiken-Ashi candle chart, that actually means something a lot more than it does on a regular candle chart, which might just be day-to-day noise. The Heiken-Ashi is meant to help you really capture those movements. So I would encourage you to read those articles, experiment with this charting form. I've talked with a number of technical analysts over the years, and particularly some Japanese analysts who are big fans of this. There are a number of other Japanese traditional charting techniques which we have on our platform, which you may or may not be familiar with. They're here on the bottom, things like Renko charts and others. I would encourage you to explore our chart school to learn more about some of those chart patterns, which honestly many Western technicians do not use very often, but there's some really interesting nuances to the construction that could help you better identify and anticipate changes in trend. Thanks for asking about those, by the way. Final question, how can I find a list of stocks and ETFs when the 20-day moving average crosses the 50-day moving average from above or below? Beautiful application of our scanning engine. Let's go to, our dashboard. I'm going to click on scans up here, and I'll probably end up just using creating a new scan. So I'm going to click here. Our scanning engine, I would tell you, is incredibly powerful. We are, actively working on the next iteration or the next version of the scanning engine, which hopefully is going to have a lot more, just some really nice UI improvements, user experience improvements to make it easier. If you're not a programmer, if you're not an engineer, make it a little easier to design some of these. We have a simple language that was designed basically to run this scanning engine. You don't have to be a programmer, though. I definitely am not. not. And so what I do is I use these drop-down menus at the bottom. And I think the trick to answering your question is going down here where it says predefined scans, right? There's a language and there's a syntax you have to use to say something like this moving average is crossing above or below this other one. But we've already created some of the most common ones and designed them as predefined scans. So if you click on that drop down, go here where it says bullish 50 to 200 day moving average cross, hit add. What that's going to do is basically add the language in here that creates that phenomenon. So if you're, and again, you don't have to be a programmer, just read the words and think about what it means. This basically says today's 50-day simple moving average based on closing prices is greater than today's 200-day moving average, right? So today, the 50 days above the 200-day. And one other thing, yesterday, the 50-day needs to be below the 200-day. So yesterday, the 50 was below. Today, the 50 is above. And don't look now. You've actually asked the scanning engine, look for something that was below yesterday and above today. So you were asking it to look for upside crosses. You can, so I would say this is the way to do it. Just change these to, 20 and 50, and you've got your scan pretty much exactly as you did it, and change it there as well. You can customize these settings. You can, and again, if you get comfortable with this syntax, you can make the scanning engine do some pretty awesome and very complicated, very complex things as much as you want. I tend to keep scans very straightforward and just try to get a larger group of stocks because my goal is to get to a working, manageable list of charts and then look visually at what some of the patterns are. So here, let's say we've made 20-day is above the 50-day. And then we also want yesterday's 20 to be below the 50-day, which would mean it's broken up. If you wanted to look at a sell signal version of this, you could just change this from greater than to less than, and that would work. I'm looking at it. I pretty much said look at every stock, which is going to be too many. So I already have about 200 things. So I will tell you the other thing I like to do is go down here and say, what about just members of like the S&P 500, which is going to be a good kind of working list of stocks that at least I know are relatively liquid, have decent, volume and things like that. And there we go. We got a list of stocks like Franklin Resources, where the 50-day has just crossed above the 200-day. And again, when you look at the results, it's going to use your default chart. So you might want to set up one that looks at the particular moving average combinations that you're interested in, and you'll capture some of these where it's breaking up. And once you've done that, I would think one of the really cool things you can do, going back on our scanning engine, is we have the ability to schedule scans. So once you create a scan and run it just one time and save it on your login, you can have this scan automated. So I have a series of scans that actually run. You can see I have 6 of them that run, some of them every day, some of them every week, and then it runs through the results and emails me a list of stocks or ETFs that fit that criteria. So once you find a scan that gives you a good working list, talk about supercharging your use of the Stockcharts platform. Turn that into a scheduled scan every day or every week or whatever frequency makes sense. Stockcharts will email you with updated results. You can look at the charts and get Stockcharts doing some of the work for you, taking it off your plate. Thanks for asking about the scan engine, by the way. Folks, that's it. Thanks so much for this asking those great questions. Hope you enjoyed this special all mailbag edition. Keep the questions coming. Our mailbag is running a little empty, and we would love to hear from you. What are you running into as you're trying to analyze the markets using technical analysis? For Stockcharts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a great weekend.